In the minds of many people, venture capitalists are placed in the same category with used car salesmen and real estate developers. Why is that? Probably because although entrepreneurs want to build great companies, venture capitalists are in business solely to make money and get out as quickly as possible. They also want the following: a huge equity interest to compensate for the risk they're taking, an enormous return on investment, a seat on your board of directors. Doesn't sound very attractive, does it? To be fair, venture capital serves an important purpose. It provides the funding that fast-growth companies need to expand. Although plenty of venture capital is out there for the taking, fewer than 1% of all businesses meet the very strict requirements of venture capitalists. For high-growth ventures, however, VC money is an important source of funding, but it should be considered a second-stage source and pursued only if no private money is available. Some businesses, particularly high-tech businesses, and those with heavy asset requirements, such as plant and equipment, find it difficult to grow organically using internal cash flows. Growth is expensive, and to do it effectively, you need to move quickly. There are additional people to hire, systems and controls to put in place to manage growth, and inventories to build up in anticipation of demand by customers. All these things require large amounts of capital that most business owners don't want to divert from their current budgets. That's where VCs come in. This type of business is more attractive than a startup because it has achieved a certain level of success. Some of the risk has been reduced, and the business is positioned to grow. Knowing what VCs generally look for puts you in a better negotiating position. You'll know what's important to them and be able to address those issues in a way that makes sense to them. Most VCs are interested in three aspects in the following order: a great market. Market size in the hundreds of millions of dollars is the minimum. Billions of dollars is much better. Surprise. From a fast-growing large market, a company can achieve high valuations that will give the investor the greatest possible return on investment. A great management team. Of course, to take advantage of big markets, you need a management team that can execute the business plan. An old adage says that VCs would rather invest in an A team with a B product than in a B team with an A product. What that means is that people make the difference in a company. VCs want to invest in a team that has a successful track record. VCs also want to see a team that's fully committed to the company, because a fast-growing company requires an extraordinary amount of time and effort. A great technology that you can protect. Traditionally, VCs have looked for the next great technology product: computer hardware, software, communications, electronics, medical devices, biotech, and pharmaceuticals, for instance. They would prefer that you have patents to protect it. VCs are now starting to do more of something they rarely did in the past. They're investing in non-technology companies with great protectable business models and huge growth potential. So you may not get money for your new brownies, but you may be able to create the next Walmart. The reason VCs are doing this is because of the lack of great technology deals in the market. To work with venture capital firms, you need to be able to locate them. The best way to do so is through a referral. Although many venture capital firms are listed in the phone book, the worst thing you can do when searching for capital is to start calling and sending out your business plan. VCs see hundreds of business plans every month, so the best chance you have of getting some attention is through a referral from someone who knows a VC and knows you too. To get a referral, you need to have spent a lot of time networking in your community so that eventually you can meet the people who can help you. Attorneys, bankers, and accountants are good places to start. This type of contact won't happen overnight, however. You have to keep working at it. After you find a VC whose requirements mesh with your venture's capabilities, deal with that investor alone. Don't shop your business plan to several VCs at once. It's a small world, and VCs don't want to feel as though they're in a bidding war for your investment opportunity. You'll discover very quickly whether a VC firm is interested or not. VCs aren't shy about telling entrepreneurs what they think of their great ideas. The first thing VCs may ask to look at is the executive summary for your business plan. If they don't find the business concept sufficiently compelling and in line with their criteria, they won't waste their time reading the rest of the business plan. If they are interested, they may call for a meeting to check out your management team to see whether you are what you say you are. You may be asked to do a formal presentation at that time, and you may be asked some very pointed questions to determine how you stand up under pressure. The first meeting is really a getting-to-know-you meeting. Others will follow as the VCs begin to do their very thorough due diligence, background checks on your team and company. If the VCs are sold on the investment, you'll move into a period of going over legal documents and negotiating what they want and what you want. Typically, what they want wins. The nature and terms of the investment will then appear in a term sheet. When the deal is set, however, it doesn't mean that the check is in the mail. VCs usually manage pools of investor money, so they have to do their own prospectus and legal documents for their investors. All this work can take several months. So the moral of the story is, don't begin the search for VC funding too late. Completing funding will take some time. Today, private equity firms are receiving a lot of press. What exactly are they, and how are they different from venture capital firms? Private equity firms are simply investment funds that traditionally have focused only on very mature, low-risk companies seeking expansion capital. Their popularity is being driven by the number of companies looking to go private to avoid the stringent requirements of Sarbanes-Oxley. By contrast, venture capital firms take on riskier ventures at earlier stages and exert more onerous requirements on them. However, in recent times, the line between venture capital firms and private equity firms has blurred a bit, mostly due to the highly competitive state of the investor market. VC firms are now investing in more mature ventures, and private equity firms are taking more risk by investing earlier.